Friends, the current startup ecosystem in India is very interesting and exciting, and we are very proud to say that the third largest startup ecosystem in the world is in India. We have created 14 new unicorns, which is the second highest number of unicorns in the first half of 2022. I'm just setting up the perspective of the presentation so that we are mindful about how fast India is rapidly growing progressively. So the concept that I want to discuss today is the relationship of an investor and an investee. So primarily, I would like to discuss what an investee should look at and what an investor should look at. So what should an investee company look out for? So first and foremost, understanding investor style and metrics. Whenever it is not necessary that an investor chooses an investee, it is also important that an investee chooses the investor. So understanding the investor style and metrics before the investee says yes is critically important. Analyzing the investor ownership patterns is also interesting because every investor comes with a background which can be verified, checked, or reviewed thanks to social media and information available online. An investee also should look out to hosting the right type of investors who can give them growth and glory. It will also be helpful for the investee to attend diversified conferences like the one that I'm attending now is also something which is fitting the category of diversified conferences. So what should the investee company showcase to get investors on board? So any one of you wanting to get invested into, this is very interesting for you to note down that when an investor looks at you, he should see the passion that you have, the traction that you have built, the significant market size that you can address to, the competitive advantage that you have created for yourself and your organization, the quality, the size, and the type of team that you have, and the exit strategy that you can explain to the investor before he'll invest. So this is what an investee company should showcase for getting the right investors on board. Now, an investor is always very interested to understand the target audience or customer base of an entrepreneur or the startup that wants to get invested into. So a customer base is made up of your most loyal and engaged customers, and asking yourself a few questions about your ideal customer can help you define your desired customer base. Every investor, I'm sure Vikas Bagga will agree to what I'm saying, every investor looks at the quality of the audience and the size of the target audience, and growing your customer base is critically important. So your acquired customer are your brand's lifeblood and they define the journey forward. So this needs to be shown clearly to the potential investor. So let me discuss what also excites an investor. The cash flow of a business is a critical element which excites the investor. So there are various classifications of the cash flow. So point number one would be operating cash flow, the money your business generates and spends on regular day-to-day operating activities. This is what we are used to every day with our businesses. But the operating cash flow is critically important to be displayed in the right way. Investment cash flow is the money that we spend on market securities, long-term assets, and as long-term assets such as property and equipment, and other financial instruments over the reporting period. So that's your investment cash flow, and your financing cash flow is the money moving between a company and its owners, investors, and creditors. So that explains the cash flow of your business. I would like to go far through the presentation purely because I'm very interested and excited to interact with most of you so that I can answer the queries you might be having in your mind. Now, how will valuation be calculated? So there are various standards and methods which are already well defined, but it is not necessary that you go by any one of these methods. You can have a combination or you can create your own methodology of valuation. As long as your investor is convinced, every method is the right method. So the first method that I would like to discuss is Barkas approach, an idea of the potential value of a startup. That's called as the Barkas approach. The second method is going to be cost to duplicate approach, valuation theory that involves calculating how much it would cost to build another company just like this from scratch. So for example, today, a lot of times when I attend events where there are investment opportunities, activities like similar to Shark Tank, lots of time the promoters pitch an amount which is 10x of how much it would cost an investor to create a similar opportunity. So that's a no-no. So cost to duplicate approach is very important to be understood well. There are offers which happen on future valuation method, valuation theory that estimates the return on investment that the investors can expect in their near future. This method is also effective because an investor can get excited on the basis of the projections that you do. But smart investors will tag along with the projections that you express so that the valuation will fluctuate on the method that you're trying to adapt to influence and excite investors. So you need to be also very careful when you project or portray the future valuation method. Market multiple approach is also very interesting. Valuation theory is based on the idea that similar assets sell at similar prices. So investors are more confident about the numbers that they can offer or accept on the basis of the market multiple approach. The risk factor summation method, a rough pre-money valuation method for early stage startups. This is what is also pretty popular these days. And the discounted cash flow method. This is also an extremely popular method of expressing your valuation to potential investors. Discounted cash flow method is a valuation method that estimates the value of an investment using its expected future cash flows. Again, the investor is going to tag along with what you express. So what will an investor look out for in a potential entrepreneur? A great product or service, that's definitely the first point that he will look at. The potential to grow. What excites an investor is scalability. Only when it is a scalable business will the investor get returns which might be 10x, 20x, 100x, or 150x. So the scalability is something that excites an investor. He also looks at a passionate and a dedicated founding team rather than only the entrepreneur. He's also going to be very excited and motivated if the founding team has a robust team which has got the potential to manage multiple roles to be played to making the business successful. He will also look at the strong financial plans. You need to be definite about what's going to be the future and how the funds investor are going to be deployed once they are deployed. He also is interested to understand clear plans for the use of the investment money so that there is no deviation or new expenses that crop up suddenly, which will create a surprise element and dissatisfaction in the relationship between an investor and an investee. The investor is also very interested to understand the risk assessment and damage limitation to the investment that he does. So what should an entrepreneur look out for in an investor? He should look out for the ability to fund. Lots of times investors commit big funds, but stop in between if they don't have the arrangement for completing the investment promised. So an investee or the entrepreneur needs to make sure that the relationship that he is building with the investor needs to be clear on the fund requirements. The investee company should also look out for the reputation for funding repeat rounds of investment of that particular investor. Also, he needs to understand the diversification portfolio of the investor so that there can be a possibility of integration. The investee also should look out at the influence that the investor wields other than the money that he is deploying, so that this influence can be utilized for the growth that the investee company is looking out for. The investee will also look out for the fit of the brand and the culture that the investor will bring in. And also, what the investee should look out from the investor is the quality and the type of control and the quality of the intent that the investor has. So what are the mistakes to be avoided once you get the investment? Well, definitely lack of planning is going to hurt the investment. So you need to be well planned with your deployment plans in place. Lack of focus. The investee company should be focused on the objective that the investment is being raised for. Also, it's going to be very important to express by the investee that diversification of money will not happen without a plan within the same business though. And also, the investee should be careful about nurturing relationship with the investors. Many a times, the relationship becomes sour after the investment is done. So the investee needs to be absolutely critically clear and careful about nurturing relationships with the investors. You can also have the advantage of forward integration and backward integration. I'll not spend time on this much. All of us know what is forward and backward integration. And how can the entrepreneur explain the further course of action after getting funded? This is also a very critical element of the investor-investee relationship. So the investee needs to deliver on the promise. He needs to set the set of goals absolutely clearly. The investee should also realign the team as per the performance that is being given by the existing team. The investee needs to update the financial model very clearly. The investee needs to decide on how much goes to reserve so that there is backup in case of a calamity. The investee should say no to unplanned expenditure, and the investee should always be ready to start planning for the next round so that the investor gets a higher valuation for the investment that he's done, and the investee gets better investors and more valuation for the business that he's operating. So that's about the presentation. That's some of my social media connects, and I would love to have questions which can be helpful to all.